We're now going to look at 4 other segments, and each one of these segments are going to deal with a typical, unique tax planning tool that we use. The first one that we're going to look at is that in the United States, we have a principle that if you have a real estate asset and you are going to sell that real estate asset and then reinvest in a similar asset, instead of paying a tax on any gain you may have from the sale of that real estate asset, the United States will permit you to reinvest the proceeds of sale into a new piece of real estate. Now, what happens is when you reinvest, let's use some numbers. Let's say you bought a piece of property for $1 million, you sold it for $2 million, you see another piece of U.S. real estate that you want to acquire, and it's cost $2 million. You would take your profits. Your profits will be reinvested in the $2 million piece of property. There won't be any taxes. But when you sell the $2 million piece of property, your original cost from your original piece of property, that's going to be your cost in the new piece of property. So you will pay, ultimately you'll pay on the $1 million in profits that you make, or if you make even more profits in the second piece of property, you'll pay on the additional profits. However, you can keep doing this on and on and on, and so long as you reinvest in real estate that is of an equal value or a higher value to the real estate that you've sold or alienated, you're not going to be subject to the tax immediately. We call this tax deferral. It's not tax exemptions or anything like that. It's tax deferral. It's moving your taxes off to a later point in time when you finally turn that investment into a cash investment.